Hello, this is Brandon Christy, President of Retirement Benefits Institute. So glad to talk to you about your TSP today. The number one thing that is searched for in our space within federal employees, providing support for you, the number one question we get continues to revolve around the use of that TSP as the third leg of your retirement stool. So today, what separates success stories from the tragic failures in financial planning is, as the term implies, sound planning. This may seem obvious, but many federal employees fail to start thinking about retirement until it is just around the corner. Earlier is better, but whatever your age, career stage, or retirement goals, the time to start planning is always now. The earlier you start saving, the sooner you can begin growing your TSP and other retirement accounts. These tax-advantaged accounts have yearly contribution limits, which means the sooner you start saving, the more assets you can shelter, and the longer your assets may be able to grow. In addition to growing your TSP, you need to think about how you will use this money later in life. Let's examine what we commonly see as the tax bracket system in America. So I'm showing you now the numbers for 2020 as it relates to the tax brackets, specifically taxable income. For many federal employees, they find they hover around the top of the 22% tax bracket or higher, maybe $140,000 married income or $80,000 single. When you look at those robust pensions like Social Security checks, spousal income, other sources of retirement income along with your federal pension, your taxable income in federal retirement may drop all the way down to the bottom of the 22% bracket. Instead of dropping to the 12% range, you may simply drop to the other end of the same tax bracket. You see in this chart how this plays out. Well, this is a unique problem to have here in America because not many people have a pension these days. A lot of advice that you may listen to on the radio or read about discusses tax deferral. Maybe you've seen someone say, save your money in the TSP, pay taxes after you retire because your tax rate will be lower. If you examine the numbers carefully, many of you may find that your tax rate will not be lower. Thus, you could be pulling out at the same tax rate you are putting in. Is that good or bad? Well, what if taxes go up? If taxes go up in the future, would you rather pay taxes now or in the future when they're higher? No one knows the future of our tax code, but it's an interesting thought to ponder. Let's examine two case studies for growing your TSP. The hypothetical figures on the screen now are for illustrative purposes only. First, we have a traditional TSP. Let's walk through the assumptions here that you see. You have a 2020 salary of $75,000. We'll assume some pay increases of 2%, a rate of return of 4%, a federal tax rate assumed at 22%. Take note, we're not dealing in state tax rates in this example. And a beginning traditional TSP balance of $150,000. So with these assumptions and a contribution rate into the TSP of 10% based on that $75,000 salary and getting the 5% match as a FERS employee, let's see how this plays out. You see here then the growth of the balance for 2020 on into those future years until retirement. And you'll find at the bottom of this list a total TSP value of the $371,928. Oh, that's a great number, isn't it? But it's not all yours in federal retirement savings. It's yours and your favorite relative, Uncle Sam's, the federal government's money. So we have to share this, right? Because you didn't pay tax on it putting it in. You have to pay tax on the way out. So when we take it out at the 22% rate that the government might get, right? We didn't say they will get, they might get. Your spendable money ends up being the $290,000 figure. Now, we're also assuming that we're not taking it all out at one time, but over a length of time to keep us in that 22% bracket. So Be careful when you look at your TSP and say, I have X number of dollars. If it's tax deferred, your TSP savings is not all yours. So the question, what portion of that money will go to the government and who gets to make that decision? The answer, the government determines what our tax rates are, which is then used to calculate the amount we owe in taxes. Take note of this. Now we're going to show a different story. Case study number 2 says that we're now going to contribute to the Roth TSP. So let's walk through the assumptions on the screen now. You will see that we make some of the same assumptions and that the salary is still $75,000. We're going to assume 2% pay increases, 4% rate of return. Again, this is not a commitment to a rate of return that you may receive or not receive. We just have to make some kind of assumption for this example. Federal tax rate assumed at 22% and a beginning traditional TSP balance of $150,000. But we're now going to look at the Roth TSP. So because you have to pay tax on the contributions that go in the Roth on the front end, but you didn't have to pay them on the front end on the traditional TSP, we have to make an adjustment on the amount that you contribute to make this fair. So if you were contributing 10% to the traditional TSP, now you're going to contribute 7.8% to the Roth TSP. You're still going to get your match at 5%. It's all going to go into the traditional TSP balance. But by doing that, we're actually making the dollars compatible for this example. So we're not tweaking the numbers to make one look better than the others. We have made it a sum zero game so that you have the same tax effect in both examples, example 1, example 2. So you'll see we had the traditional TSP that started at $159,000 and it grows to the $272,000 if you retire 10 years from now in this example. And that amount still has to be taxed, right? We have to pay tax on that traditional TSP because we didn't do it earlier. On the second column, you'll see a Roth TSP. And it starts with nothing and slowly begins to grow because you're contributing part of your pay to this account. And then by the time you retire, there's almost $78,000 tax-free money in this account for you to enjoy in retirement. So we now have a blend of the traditional TSP and the Roth TSP coming together into one account. And now once we assume a tax rate of 22% on the traditional TSP side, your net spendable amount of money, oh look, it's the same number we had a little while ago from example 1, $290,000 of after-tax money for you to spend in retirement. So if you see the two examples, example 1, example 2, the net spendable income is the same for you in retirement if taxes stay the same. If your taxes will go down in retirement, then what should you do? You should consider deferring tax until later because you'll pay less later. Are taxes going up in retirement? Then you better do the Roth. If you're unsure, if you're not sure if your taxes are going to go up or down, then maybe you need to be doing some of both. Maybe you need to diversify your tax planning. Remember, Solomon, the richest, wisest man that ever lived on the earth, said to diversify, to spread your different ways in which you handle your money. And I think that's not only good for investing, it's also good for tax planning, in that you consider some traditional. You've already done that. Most of you that are watching this have most of your money in the traditional TSP. But you also consider building some Roth. That way, if taxes go up for you later in retirement, which is a reality in our world today, we're in very low tax rates historically speaking. If taxes go up, you will have some money in a tax-free status inside of the Roth IRA. So as I try to help you prepare for retirement, I want you to remember it's not just about what you have in your TSP. It's what you get to keep and what you get to use through that retirement day. So I encourage you to look carefully at the Roth TSP. We have many, many other resources available for you online for Roth. And even better than that, we have analysts standing by ready to help you now to bring about clarity and the confusion of how your retirement income is going to work. How are you going to combat the two big enemies in retirement, which are taxes and inflation? The Roth TSP is a wonderful opportunity, a wonderful tool to use to help you go against that danger. So call us, reach out to us. You can go online and communicate that way. You've got our number here to give us a call, 877-864-1145, or you can click the Get Support button for further information. Until next time, thank you.